All right, let's jump right into this. Today, we're taking a deep dive into a really fascinating blueprint of global commerce. We are unpacking the Procter Gamble Fiscal Year 2026 earnings report. We're going to take all these dense spreadsheets and percentages and transform them into a clear, engaging narrative so you can grasp exactly what is happening under the hood at one of the world's largest consumer goods companies. When you see that iconic blue and white P&G logo, you've got to think of it as a massive, massive global ship. Think about the sheer logistics, the supply chains, the scale of moving everyday essentials like Tide, Pampers, and Gillette across something like 70 countries worldwide. This explainer is ultimately about how that colossal ship is trying to steer through some seriously choppy economic waters. And I actually want to anchor our entire narrative today on this specific quote from Shailesh G. Juker, the president and CEO. He said, Fiscal 2026 was a year of foundation building despite a very challenging geopolitical and economic environment. You know, corporate earnings can feel super dry until you view them through the right lens. Today, we are going to look at these numbers as a story of pure resilience and strategic foundation building in the face of some very stiff winds. So we're going to break this down into 5 quick chapters. First, a year of foundation building. Then, we'll look at segment winners and losers, returning cash to shareholders, the Q4 reality check, and finally, the 2027 outlook.
All right, Chapter 1, a year of foundation building. Despite those intense economic headwinds we just talked about, P&G actually pulled off a really solid year. Look at that top-line number. Net sales hit a staggering $87 billion. That is a 3% bump from the year before. And if you strip away the noise, stuff like currency exchange rate fluctuations or brand acquisitions, their pure baseline organic sales still grew by 1%. Now, it's worth noting that growth was entirely driven by higher pricing. And hey, that top-line growth, it actually made its way down to the bottom line too. Diluted earnings per share, or EPS, ticked up 2% to $6.62 for the fiscal year. Even if you look at core EPS, which strips out those non-recurring restructuring charges, that went up by 1% as well. So, big picture, the ship is definitely moving forward. Moving into Chapter 2, segment winners and losers. So a beast of a company like P&G isn't just one single entity, right? It's a massive collection of different brands and businesses. We know overall sales went up, but where did that growth actually come from? How did shifting everyday consumer habits actually drive these results across the globe? Well, if we look at the 5 main segments doing the heavy lifting, beauty was absolutely the powerhouse here. They saw a 7% jump in net sales. Grooming and healthcare both pulled in a really solid 4%. Fabric and home care grew by 2%, and bringing up the rear was baby, feminine, and family care with just a 1% increase. Let's actually contrast the two extremes here, focusing just on organic sales. The beauty segment grew 4% organically. Why? Basically, people were buying way more haircare products globally, and their super premium brand SKI killed it, even with some volume dipping in Greater China. But then, you have the weakest link. The baby, feminine, and family care division actually shrank by 2% organically. They just got hit with a tough combo of selling fewer physical items and having to lower prices in some categories. It just goes to show how different parts of the exact same company can be experiencing, totally different economic weather. Which brings us to Chapter 3, returning cash to shareholders. Here is a crucial takeaway. P&G did not just sit on those profits. They returned an absolutely staggering $15 billion of value to their shareholders in fiscal 2026. $10.2 billion of that went straight out as dividend payouts, and the remaining $5 billion went into share repurchases, which, as you probably know, shrinks the number of shares on the market and boosts the proportional value of the ones left over. Now, I want to pause for a second on a very specific number: 70. In the chaotic, totally unpredictable world of modern business, this number carries a ton of historical weight. That number represents the fact that in April 2026, P&G marked its 70th consecutive year of increasing its dividend. I mean, just think about that for a second. Through recessions, global crises, massive shifts in how consumers shop, they have bumped up that payout every single year for 7 decades. And they've been paying a dividend period for 136 consecutive years, literally since they incorporated back in 1890. It is an absolute masterclass in long-term financial stability. All right, Chapter 4, the Q4 reality check. Because look, even a 136-year-old ship hits storms, right? As strong as the full fiscal year was overall, we have to contrast that with the stark reality of the fourth quarter, so April to June 2026.
In that specific quarter, diluted earnings per share suddenly plunged by 15%, dropping down to $1.26. And organic sales? Completely flat. The momentum just kind of hit a wall right at the finish line.
So what exactly happened? Well, the report lays it out pretty clearly and impartially. Their SG&A, which is the selling, general, and administrative overhead costs of running the business, shot up by 160 basis points as a percentage of sales, mostly because they were pouring money back into marketing. Meanwhile, their gross margin shrank due to a less-than-ideal mix of products being sold and higher commodity costs. Throw in some major non-core restructuring charges to streamline their portfolio, and basically, it just cost them a whole lot more to run the business in Q4, which squeezed their profits pretty hard.
And finally, Chapter 5, the 2027 Outlook.
Looking ahead, management is laying out a pretty cautious but optimistic battle plan for 2027. They're predicting modest all-in sales growth of about 1 to 3%. On the bottom line, they expect core earnings per share to land anywhere from flat to up 3%, which puts the midpoint right around $7 a share. So, no, it's not explosive growth by any means, but it represents steady, forward progress.
But, and this is absolutely critical for understanding the macro climate right now, we have to highlight what they are up against. P&G estimates they are facing a massive $1 billion after-tax drag on profitability in 2027. This is coming straight from the rising costs of raw materials, energy, and transportation. That alone equates to an 8% drag on their core EPS growth, literally before they even open their doors in the morning.
Which brings us to the ultimate question of this explainer. The CEO insists that the best way forward is to double down and, in his words, put the consumer first in everything we do. But can that strategy, even with razor-sharp execution and productivity savings, actually overcome $1 billion in pure economic headwinds this coming year? That is the central tension of this report, and it is absolutely something you'll want to watch as this corporate titan navigates the year ahead. Thanks so much for hanging out with me for this explainer. Keep learning, keep questioning, and I'll catch you next time.